Have you ever stopped to think that the money sitting in your bank account may actually be losing value every single day? At first glance, your account balance may look exactly the same. You might even be adding to your savings on a regular basis, but when you go grocery shopping, pay your bills, or try to buy a new smartphone, you realize that the same amount of money simply doesn't buy as much as it used to. That's exactly how inflation works. It moves quietly, often without being noticed. Yet over time, it can significantly reduce the purchasing power of your savings. Many people keep their money in a bank account because they believe it's the safest place for it. And of course, having cash available for emergencies is important. However, money that sits idle for long periods without being invested can gradually lose value during times of high inflation. So, is there a way to prevent this? The answer is yes. By choosing the right investment vehicles, you can protect your purchasing power and even increase your chances of earning returns that outpace inflation over the long term. The good news is that you don't have to be a professional investor or memorize complicated financial jargon. What truly matters is understanding how money works and becoming familiar with the right investment options. In this video, we're going to explore 5 investment options that have been trusted by investors for years and continue to be among the strongest tools for protecting wealth against inflation today. We'll discuss the strengths of each investment, the risks you should be aware of, and the type of investor each option is best suited for, all in a simple and easy to understand way. By the end of this video, you'll have a much clearer understanding of which investment strategies may be the best fit for your own financial goals. If you don't want inflation to slowly erode the value of your savings and you're looking for smarter ways to manage your money, you've come to the right place. So, without further ado, let's begin with the first investment option that has consistently stood out as one of the strongest defenses against inflation. At the top of our list are gold and other precious metals, which have been regarded as safe haven assets for centuries. So, why have people trusted gold for hundreds of years? The primary reason is its limited supply. While central banks can increase the amount of paper money in circulation whenever necessary, gold cannot simply be created on demand. The world's gold reserves are finite, and extracting new gold requires significant time, effort, and expense. This scarcity is what makes gold particularly attractive during periods of high inflation. As the purchasing power of paper currency declines, gold has historically played an important role in preserving wealth over the long term. It's not only individual investors who rely on gold. Many central banks around the world continue to hold a significant portion of their reserves in gold, reinforcing its status as one of the most trusted stores of value within the global financial system. However, it's important to remember one key point. Gold does not rise in value all the time. Its price can experience significant fluctuations in the short term. For this reason, gold is generally favored by investors who are focused on preserving their wealth over the long run, rather than seeking quick profits. So, how can you invest in gold? The most traditional approach is to purchase physical gold, such as gold bars, bullion coins, or small investment-grade gold products. However, owning physical gold comes with certain drawbacks, including secure storage, insurance costs, and the price spread between buying and selling. Because of these challenges, many investors choose alternatives such as gold savings accounts offered by banks or exchange-traded gold securities. These options eliminate storage concerns while making buying and selling far more convenient. Alongside gold, silver is another precious metal that deserves attention. Thanks to its wide range of industrial applications, demand for silver often increases during periods of economic growth. As a result, many investors include silver alongside gold as part of a diversified investment portfolio. In short, if your goal is to preserve the purchasing power of your savings over the long term, gold and other precious metals remain among the strongest and most reliable investment options to consider. Coming in at number 2 is an investment option that deserves the attention of anyone looking for a lower risk approach: inflation-linked bonds and other inflation-protected investment products. If your priority is preserving the value of your savings rather than maximizing short-term returns, these investment vehicles may be an excellent choice. So, how do they work? Under normal circumstances, if you invest your money at a fixed interest rate and inflation turns out to be higher than expected, the interest you earn may not be enough to maintain your purchasing power. Inflation-linked investments are specifically designed to address this problem. With these investment products, returns are tied to the rate of inflation. In other words, when inflation rises, the return on your investment is adjusted accordingly. Some products even offer an additional fixed real return on top of inflation, allowing your investment to grow not only in nominal value, but also in real purchasing power. For this reason, inflation-protected investments are often favored by investors seeking greater stability during uncertain economic periods. However, it's important to keep one thing in mind. The primary purpose of these investments is not to generate quick or exceptionally high profits. Instead, their main objective is to preserve the value of the money you've worked hard to save by protecting it from the long-term effects of inflation. Compared to more volatile assets, such as stocks or cryptocurrencies, inflation-linked investments generally carry a much lower level of risk. That makes them an attractive option for investors whose top priority is capital preservation rather than aggressive growth. In short, if your primary investment goal is to protect the value of your money, inflation-linked bonds and other inflation-protected investment products deserve serious consideration as part of a well-diversified portfolio. Coming in at number 3 is an investment option with the potential to outperform inflation over the long term, shares of high-quality companies. When people hear the word stock market, many immediately think of high risk and sharp price fluctuations, and it's true, stock prices can experience significant ups and downs in the short term. However, over the long run, companies with strong fundamentals have historically been among the investments capable of creating real value for shareholders, even during periods of inflation. So, why is that? When inflation rises, many companies are able to pass their higher operating costs on to customers by increasing the prices of their products and services. In finance, this is known as pricing power. Companies with strong pricing power are generally better positioned to protect their profit margins despite rising costs. Over time, this can contribute to stronger business performance and potentially higher stock prices. Of course, not every company has these advantages. That's why selecting the right businesses is one of the most important parts of successful investing. For example, companies that generate a significant portion of their revenue in foreign currencies may benefit from exchange rate movements. Likewise, businesses operating in essential sectors such as consumer staples, food, healthcare, and retail often demonstrate greater resilience because people continue to rely on their products and services regardless of economic conditions. However, it's important to remember one crucial point. A company's past success does not guarantee future performance. Before making any investment decision, it's essential to evaluate a company's financial health, business model, competitive position, and future growth prospects. But what if analyzing individual companies feels overwhelming? That's where investment funds come in. Investment funds are professionally managed portfolios that combine shares of many different companies into a single investment. Instead of putting all your money into one business, you gain exposure to dozens or even hundreds of companies at once, helping you diversify your risk. Even better, you can achieve this with a single investment while benefiting from the expertise of professional portfolio managers who handle stock selection and ongoing portfolio management on your behalf. In short, if you're investing with a long-term perspective and aiming to achieve returns that outpace inflation, shares of financially strong companies or professionally managed equity funds can be among the most valuable investment options to consider. Coming in at number 4 is one of the most traditional and widely recognized investment options, especially in countries like Turkey: real estate and land. For many people, owning a home or a piece of land is more than just an investment. It's a symbol of long-term financial security. And there are several good reasons why. First and foremost, land is a finite resource. Unlike paper money, new land cannot simply be created. Meanwhile, populations continue to grow, cities keep expanding, and the demand for housing and commercial space remains strong. As demand increases while supply remains limited, real estate has historically benefited from long-term appreciation. Another important factor is inflation. During periods of rising inflation, construction costs tend to increase as well. Higher prices for cement, steel, labor, energy, and other building materials make new developments more expensive to build. As a result, the value of existing homes and land may also increase over time. One of the greatest advantages of real estate is its ability to generate recurring income. If you rent out a property you own, rental income can provide a steady cash flow. In many cases, rental rates are adjusted over time, helping to offset at least part of the impact of inflation. However, it's equally important to consider the other side of the equation. Real estate typically requires a substantial initial investment. In addition, buying and selling property is generally much slower than trading stocks or investment funds. In other words, converting a property into cash can take time when you need liquidity. That's why it's essential to consider your cash flow needs before investing in real estate. But what if you're thinking, I don't have enough money to buy a house or land right now? Fortunately, there is another option worth considering. Real estate investment trusts, commonly known as REITs. REITs are companies that invest in income-producing real estate, such as shopping malls, office buildings, residential developments, hotels, warehouses, and other commercial properties. Because their shares are publicly traded on the stock market, they allow investors to gain exposure to the real estate sector with a much smaller amount of capital. Of course, since REITs are traded on the stock market, their prices can fluctuate in the short term. However, for investors with a long-term perspective who want to diversify their portfolios, they remain an attractive alternative. In short, whether you choose to purchase a home or land directly, or invest through REITs, real estate continues to be one of the most important asset classes for protecting wealth against inflation over the long term. Last but certainly not least, we come to an investment category that often attracts attention during periods of high inflation and currency volatility: foreign currency-based investments. When the purchasing power of a local currency begins to decline, many investors choose to allocate at least a portion of their savings to assets denominated in foreign currencies. The goal is simple: to avoid relying entirely on a single currency and to build a more balanced investment portfolio. However, there's an important detail to keep in mind. Simply buying foreign currency and leaving it in a bank account for years is not always the most effective strategy. After all, the US dollar, the euro, and other major currencies are also affected by inflation in their own economies. In other words, foreign currencies can also lose purchasing power over time. That's why many investors prefer to put their foreign currency to work instead of letting it sit idle. One popular option is Eurobonds. Eurobonds are long-term debt securities issued by governments or financially strong corporations in a foreign currency. These investments typically provide periodic interest payments in that currency, making them an attractive choice for investors seeking a steady stream of foreign currency income. Another excellent alternative is international equity funds. These funds allow you to invest in some of the world's leading companies without having to select individual stocks yourself. Through funds focused on technology, healthcare, artificial intelligence, energy, or broad global market indexes, investors can gain access to international markets with ease. For example, funds that invest in some of the world's largest technology companies offer the opportunity to benefit not only from the long-term growth potential of those businesses, but also from returns generated in foreign currencies. However, it's important to remember that stock markets can be volatile, and short-term price declines are always possible. For that reason, foreign currency investments should not be viewed as a complete solution on their own. Instead, they are often most effective when combined with other asset classes, such as gold, equities, and other investments, as part of a well-diversified portfolio. In short, rather than simply holding foreign currency, investing in assets that generate income or offer long-term growth potential in foreign currencies can provide stronger protection against inflation, while helping you build a more resilient investment strategy. As you've seen, there's no single perfect investment that can completely protect you from inflation. Every investment option has its own advantages, risks, and ideal use cases. That's why one of the most common strategies used by experienced investors is diversification. Instead of putting all your savings into a single asset, they spread their investments across different asset classes to reduce overall risk. In the financial world, this strategy is known as portfolio diversification. Gold, inflation-protected investments, high-quality company stocks, real estate, and foreign currency-based investments all play different roles in a well-balanced portfolio. By building an investment strategy that matches your financial goals, risk tolerance, and investment time horizon, you can significantly reduce the impact inflation may have on your savings. Of course, it's important to remember that no investment is completely risk-free. Every investment decision should be based on your personal financial objectives and individual circumstances. The information shared in this video is intended for educational purposes only. Before making any investment decisions, always conduct your own research and consider seeking advice from a qualified financial professional if necessary. Now I'd like to hear from you. Which investment do you rely on to protect your wealth from inflation? Or are you still deciding on the best strategy? Share your thoughts and experiences in the comments below. I read every comment and do my best to reply whenever I can. If you found this video helpful, please give it a thumbs up. It really helps the channel reach more people who are interested in learning about personal finance and investing. And if you'd like more clear, practical, and trustworthy content about investing, money management, and building long-term wealth, don't forget to subscribe to the channel and turn on notifications so you never miss a new video. Thank you so much for watching. I'll see you in the next video. Until then, take care and invest wisely.